Welcome to Shareholders of a Better World, brought to you by TBLI Group. At TBLI Group, we have an established reputation as an organization dedicated to building the ecosystem of global sustainability and impact investing. We're doing this through educating, advising, and facilitating transactions in global sustainability and impact business, as well as capital solutions for private companies, family offices, and fund groups. For nearly 25 years, TBLI Group has created a vertically integrated ecosystem of education to action through TBLI conferences and TBLI consulting. More about our company can be found at tbligroup.com. This webinar is brought to you by TBLI Foundation, which hosts educational learning experiences dedicated to a better planet. Through the foundation, we build sustainable communities by sharing the people and the experiences making a difference to so many of our lives around the world. Our weekly podcasts bring impact thought leaders that are doing and not only chatting. Now let me introduce my guest today. There we go. Thank you all for joining us today. I'm honored to have the dream team of one of the most successful fund managers and fund of funds in Europe. Today we have Dr. Andreas Nilsson, who is the Managing Director and Head of Impact at Golding Capital Partners and responsible for impact investments. Prior to joining Golding, he was Managing Partner of Solons, an impact-focused private equity fund of funds, which he founded in 2015. Before that, he worked as a private equity investor at EQT and UBS, and Andreas holds a PhD in finance from the Stockholm School of Economics. Thorsten Birke leads as a managing director of the international clients coverage at Golding Capital Partners. He has 19 years of capital market experience, which he gained at banks such as UBS, as well as financial services firms in Munich, Frankfurt, Zurich, and New York. Thorsten holds a master's degree in economics from the Ludwig Maxwell University of Munich, as well as the Chartered Alternative Investment Analysis and Analyst certification. Dr. Lorenz is a finance manager at Golding Capital Partners and responsible for regulatory reporting for insurance companies and banks, as well as risk modeling and data analytics. He previously worked as a risk manager for the private health insurance segment, focusing on financial mathematics topics related to Solvency II and the ongoing development of the risk model. Lorenz holds a PhD in stochastic process and nonlinear dynamics from the Ludwig Maximilian University of Munich. Thank you all very much for joining us today. I'm going to hand over now to Thorsten Birke, who will start the presentation, and I will go on mute and turn off my camera. Thank you, Thorsten, for doing this.
Great. Many thanks, Robert. And ladies and gentlemen, good morning, good afternoon, and good evening. So you should see your screen now. On behalf of the Golding team, a very warm welcome to our webinar on impact private equity investing. In today's session, we will be taking a closer look on how to create an attractive and well-conceived impact portfolio in private equity. And in addition, we will be exploring the question of how to best access the asset class private equity, both from a risk and from a return perspective. And be sure there will be surprising and maybe even counterintuitive results. All findings that we will be presenting are based on hard facts, statistical analysis that we ran on thousands of data points, our own data that we gathered during 23 years of private equity investing and enriched by renowned data providers. But let me start with a simple question. Why does it make sense to listen to Golding Capital Partners? Who are we? Well, first of all, Golding Capital Partners is a proven and established asset manager for alternative investments, looking back on 23 years of active investing in that space. We are an independent and owner-run company with German roots, managing 14 billion of clients' money on behalf of 230 institutional investors. Investors such as pension funds, insurance companies, family offices, and foundations from across Europe and beyond. Our journey towards sustainability started in 2013 and kept growing in importance ever since. Launching a dedicated impact strategy in 2021 for us was the last and very logical next step to our evolution. Dr. Andreas Nilsson and his team is leading these efforts, but we as Golding, the whole company, wants to be at the forefront of providing investment solutions to our investors that help transform our economy towards a sustainable future. You may now ask, well, I like your ambition, but what's the track record? Is there a proof of concept? Let's say over the course of years, we launched 60 closed-end fund of funds and other vehicles. Out of thousands of globally available investment opportunities, we executed a rough 500 primary, secondaries, and co-investments on behalf of our investors. For the buyout side of things, or private equity side of things, this results in a combined 16% of return to our investors. And even more importantly, we never lost money on any of our funds. What's unique about Golding is that impact might be a new strategy to us as a company, but not for the impact team itself. They manage a dedicated impact fund of funds at their company prior to joining the Golding platform. Out of a global universe of more than 900 funds the team is tracking, they already built a portfolio that is performing an astounding 19% gross return to date. So I hope you now agree that we can bring something to the table. And now let's dive into the topic of impact strategy. Andreas, how do I build a proper portfolio and what are the things I have to take into consideration?
Good question, Thorsten. Thank you. So before we start with the details, let me start with a macro view on impact investing. Impact investing to us at Golding means investing in companies that create significant contribution to mitigating climate change, biodiversity loss, or global inequality, primarily through the products and services offered. This is our definition. It's not everybody's definition. The reason we have chosen this is because we have long observed as an investment firm that the shift in our society towards sustainability is affecting every part of our economy, and that this has very strong drivers. Number one, there's a change in consumer and corporate behavior towards sustainability. Number two, there are new cost-effective, sustainable technologies coming to the market, enabling this. And thirdly, there are very favorable regulations being put in place to support this. This definition of impact investing means that it is today a very good market opportunity for investors and should be part of every portfolio, according to me. Now, to be successful, you need to set a strategy that is diversified. And on the next page, you will see how we think about diversification across sectors, regions, and company stages. This strategy is developed by us and is an example of how it could be done, is how we do it, based on external and internal analysis that targets those topics with the biggest potential for both financial returns and measurable impact. On the sector side, our focus is clearly on climate technologies. Here we're talking about energy transition and efficiency, such as decentralized storage or smart grid solutions. It's also about food and agricultural technologies. By 2050, the planet needs to feed 2 billion people more in a sustainable way, using the same resources that we have today. So as we know, many listeners to this podcast, to this webinar, will know that we really need to transform our food system. We're also looking at circular economy solutions, such as recycling and sustainable materials, as a way to reduce plastic and packaging waste. Also looking at transport and mobility within this space. We also believe that there are opportunities outside of climate technologies, such as inclusive finance. This is here because we have as a team seen and have over the last 10 years very good experience with investing here, because there is a revolution taking place in emerging market when it comes to digital financial services. This means that individuals and small companies have access to affordable financial services through their mobile phones. But it also means that it enables new business models to take shape and expand in the form of solar energy for smallholder farmers, for example, that would not otherwise be possible. There is, as you see, a whole host of different technologies and opportunities out there that investors need to bear in mind. Geographically, there are opportunities all over the world, many of them in Europe, North America, but also in some of the larger, more stable regions of emerging markets. And with a small mix of, say, 25%, it's possible to take advantage of these opportunities while maintaining an appropriate risk profile. When it comes to company stage, there are opportunities along the entire stage possibilities of private equity. Growth, here it's about helping companies that have sales that need fresh capital for further growth. 80% of the technologies that we need for the transition by 2030 are available today, according to studies, and these just need to be scaled up and brought to the market. That's what growth is about. In the buyout segment, there are opportunities to invest in larger, more established companies that are contributing to the transition, also benefiting from the transition. These companies are out there, and there are today many opportunities to invest in these as well. And this is what we mean by a diversified portfolio. This is what investors are dealing with today if you're approaching impact investing. On the next page, you'll see what is the fund universe. If we're looking at private equity funds focused on impact, there is almost 1,000 funds today. This is something that we as a team have been tracking for the last 10 years and investing into this space. At the moment, we're receiving 5 inbound requests per week from new managers. We also go to conferences. We exchange ideas with existing investors, large foundations, family offices, or even development finance institutions. So these funds are out there today and makes for a rather complex situation for investors. So against this background, against these challenges perhaps, on the next page, you will see, I'll show you, when you've set the strategy, then you have to think about what's the access route that you would like to have. We'll now move to the topic of the day to look at the risk-reward benefits of various access routes to impact investing and to private equity. Obviously, as a first step, you can invest directly into companies. This allows the investor to be very close to the asset, own it directly. If you have the expertise to be a shareholder of a direct company, that is the way to go. Many traditional investors lack this expertise. The second access route is to invest into a private equity fund directly. This is a pretty straightforward way. You have one fee layer with a fund manager, but as you saw, there are many different types of funds out there, and they're globally spread globally, so there is a selection risk to that. Thirdly, you have the option of investing into a fund of funds, where you have a highly diversified, easy access to these opportunities. But we will come to this in more detail. What about this double fee layer? Now, as Thorsten mentioned initially, we have done a lot of empirical research on this, on the risk reward of fund of funds compared to single funds and direct investments. And I will now hand it over to my colleague Lorenz, who will take you through that statistical analysis.
So thank you, Andreas. So as you have seen, there are different ways to invest your money into private markets and impact in particular. Basically, these 3 as shown here. But from an investor perspective, it's the question of what are the implications in terms of risk, financial risk. And even more so, if you're confronted with a new asset class like impact, where there's not as much history as it is for other private equity niches. It's the question of what is the best strategy to tackle unknown and potentially large financial risks. So of course, intuitively, we think that a highly diversified portfolio like a fund of fund is in principle less risky, as you would just think it is the case in the liquid world for liquid assets. But the question still is that really the case? And in fact, it's not an easy question to answer because private investments, by definition, are undisclosed to a broader audience, and you cannot just look up the data on Bloomberg Terminal and do the research yourselves. And that's what we have done. If you go to the next slide. So we have done an extensive study to actually shed light on this question of how diversification, as given via different access routes, so fund of fund investments, single funds, or individual portfolio companies, affects the investment risk. So the basis for the study were two large data sets. One being our extensive internal database, which is very granular. It has a history of more than 20 years and more than 100,000 data points. And the other database is the database of Cambridge Associates, which is an independent data provider that is commonly known in the market for its large coverage in terms of market capitalization and also over time. I should mention that this is, of course, focusing on private equity, as impact is a part of that. Still, we have done this analysis also for other private market sectors. Now depicted as in this small cartoon, the aim of the study was to decompose all this portfolio data into the three different access routes that are available, and by them, the degree of diversification. And then measure how they performed over time to obtain some kind of solid statistical data. So as illustrated here on the right-hand side, we recorded distributions of net return. That is, which fraction of respective investment would gain or lose a certain amount of money. Now, here the effect of diversification is then hopefully reflected in the the properties of those distributions, as illustrated here by the red arrows. You would expect that a less risky investment is then less volatile, hence it has a narrower distribution of net returns. So on the next page, what have we done? So what have we found? And before I actually show the data, let me please first stage the dimensions, or set the dimensions right. So one term to look at risk is to look at the short-term risk that an investment is facing. That is, here for private markets, we look at quarterly returns. That is to look at the value or the valuation or NAV or whatever you call it of an investment over time, and observe if it goes down, up, and so on and so forth. So why quarter to quarter? Basically, this is the shortest unit of time that we in private markets encounter, which is, of course, unlike public markets where you have any time frame that you want. Now, measuring performance over time is certainly good and all, but when it comes to the actual stake of the investors, it's more interesting to look at the long-term view, as an investor in private market is typically committed for many years to come and doesn't really care if it wiggles around in the quarters, but the essential thing is what is there ultimately to gain in an investment and whatnot. And to measure this, we can also derive performance in terms of money multiples, which is the quantity of choice for private market investments. Money multiple is the ratio of the net generated value of an investment versus the invested capital, meaning that a money multiple above 1 indicates a net gain, below 1 a net loss. So this is a good idea to, look at the investment and see what is the distribution in these dimensions. Now let's say I would like to invest into a single portfolio company. So I put all my money into a single asset and try to, find a good solution there. What would happen? So here's the data on the statistical data for individual portfolio companies. And let me please explain what you see here. So this is the cumulative distribution of quarterly returns, meaning that when this gray curve intersects the 0 line at about 40%, it actually tells you that there's a chance of 40% that your investment will have a negative quarterly return, or likewise a 60% chance of having a positive return. You can spin it further and see, okay, there's a 20% chance that your investment will have a quarterly return of -5% or less, and even a 10%, so 1 out of 10 investments will have a negative quarterly return of -15% or more. So put together, it actually fluctuates a lot over time. Commonly known that you say that you have a broad distribution, and you can see that the steepness of this curve is distributed over the whole frame here. Now, this is already, I would not say shocking, but it tells you that there's a large volatility of your investment. But what happens if I look at the long-term view of that? So will I, in the end, earn money with that or not? And the answer is that it actually is a very big gambling. So again, let me explain what the graph means. So if you look at the 50% line here, so when the gray curve intersects 50% or roughly into the 50% line, you will have a money multiple of roughly 2, meaning that there is about a 50% chance that your multiple will be above 2. So where you will, by a coin flip, you will double your investment or not. But on the other side, you will also have a roughly 1 in 4 chance that you will actually lose money with that. So you have a multiple of less than 1. And even worse, you have, as indicated by this red shading here, you have a 5% chance, so 1 out of 20 of your investments will completely fail. So you will get 0 money out of that and have a multiple of 0. So put together, this really, flipping the coin or rolling the dice. So if I were a risk-sensitive investor, would that be a meaningful strategy for me? Maybe not so much. So let's try out a different investment path. And instead of investing into a single portfolio company, invest into a fund, which the fund itself then invests into multiple portfolio companies. What is then to expect in terms of short-term risk? Now, the corresponding green curve is cumulative distribution of quarterly returns for funds. And as you can see by the red arrows, already here, there is a reduction in the volatility, meaning that the valuation over time doesn't fluctuate as much as an individual investment does. Even more importantly, if you look at the long-term view in terms of money multiple, you will find that the distribution is also very much narrowed. So, one step further, please. So as indicated by red, so this is the danger zone where you have a money multiple of less than 1. The area is already quite reduced. So it's a substantial reduction of the risk of loss. And even more so, there is no data point that actually shows you that you will completely use your money. So you will still get something back. But there's already a quite big reduction of risk. Intuitively, this is quite clear, right? So you have basically, you're averaging out over the very extreme positive or negative events in terms of portfolio companies. And the fund performance is then, an aggregate of the underlying portfolio, which makes sense. So it really seems to be the case that diversification works fine on the fund level already. So this seems fine, doesn't it? Well, let's first and at last also show the case for a fund-of-fund investment. So on the left-hand side, you will see that the corresponding distribution of quarterly returns is even narrower than it is for single fund investments. And to put everything together and frame what that means in words, it means that you have roughly a 5% chance for your single portfolio company that it will crash by 30% or more, whereas in the same quantile for fund of funds, you will only see a bump of about -5%. So volatility is massively reduced as compared to individual investment, but also as compared to single funds. Even more so if you look at the money multiple statistic. I find this personally quite impressive, because what it tells you is that, you remember when I told you that there is a 1 out of 20 chance that your single portfolio company will completely hit the wall, you will get 0 back. Now, for the same quantile in terms of fund investments, you will not lose money, but you will actually have still a positive multiple of about 1.1. And that is the worst data point that we have in the statistics. So I find it quite impressive. And this comes from Cambridge Associates, which has a long history and a lot of data that tells you that it's, put in other words, very hard to actually lose money with a fund of fund. There's a different aspect in that. So if you look at all the curves and how they lay on each other, you might notice that this blue line representing the fund of fund distributions are not only squeezed version of the other distributions, but they're also slightly shifted toward the right-hand side, meaning towards higher net returns. And that tells you that on average, it is more likely for a fund of fund investment to perform better than the other types of investments. So it not only has risk implication, but it also has return implications. And we will come to that also later. So let's take these graphs and put everything together into more quantitative risk observables that you might also be familiar with in terms of volatility. So for the short-term risk, we found that the volatility of quarterly returns for fund-of-fund investments is about roughly 5%. So typical size of fluctuations from quarter to quarter. Whereas if you do the statistics for a single portfolio company, as you can see here, it's a massive reduction. It's more than a factor of 10 less volatility, and even a factor of 3 less volatility than for single funds. So there is a massive reduction in the short-term risk, so how an investment evolves. Similar thing can be seen for the money multiple statistics, where you see that we have a uncertainty of your overall investment outcome of about 0.5x, which still sounds quite a lot, but in fact it isn't if you compare that to the statistics of a single portfolio company where you would have massive fluctuations. So you might, well, it's basically like playing roulette, right? You might still end up with a unicorn, but most of the times it will fail. So put together, I think we find very solid evidence, not only in our database, but also in the broad market database that is available, that diversification is not only present, but it's the tool of the box, the method of choice to reduce and to manage risks in private equity or private market investments, and hence also for impact investing. So with that, I would hand over to Andreas, and he will enlighten you with the not risk side, but a different side of fund-of-fund investments.
Thank you, Lorenz. Yes. Now, this is the risk side. Let's look at the costs and returns. Let's start with the costs. What does it cost to invest into a fund of funds to get all of this diversification? First of all, I think that the fees of a fund of funds should be very transparent. And this is the way we operate. This waterfall chart breaks down the individual components of a real example that we have calculated. Now, what you see here are the return expectations of an investment. And as you can see, that the total net effect is between 2 and 3%. And this is not the fee, this is the effect on the returns of investors. Calculating this in a different way would imply that it amounts to roughly a half an investment associate, the cost of having half an investment associate. So I just want to throw that out there for you to think about the do-it-yourself versus the fund of fund solution. Now, even more important to this is these components is what do they stand for? What do they bring investors? So number one, there is an active cash flow management that boosts the IRR slightly for investors and also reduces the frequency of drawdowns. Number two, there is obviously a dedicated team of specialists that set the strategy and select around 15 funds globally based on in-depth due diligence, and also in our case, the investment committee of Golding Capital for the entire company that is involved, as well as legal and structuring experts that negotiate LPAs and negotiate side letters. Thirdly, we provide consolidated reporting on financial and impact. And these are according to strict requirements of institutional investors. And it also, in our case, includes many different items, such as cash flow projections on the financial side. And on the impact side, we provide reporting that is compliant with Article 9 criteria of the SFDR. Number four, there are certain custodian services provided by third parties. Number five, there are some other services provided by auditors, legal and tax advisors to ensure institutional level governance of the fund. And finally, there's a performance fee payable only once investors have received a certain minimum financial return to ensure that there is a one-to-one financial interest alignment between investors and the fund manager when it comes to selecting the best possible target funds. Now, as I mentioned, this is actually a very good value for money if you compare to the do-it-yourself option of creating this type of portfolio, which would cost significantly more. But that's not all. Let's take a look at what the data tells us about the actual cost benefits of a fund of funds. And for this, I would like to hand back to you, Lorenz, to show us that.
Thank you, Andreas. Yeah, basically the burning question from this arises is, well, you have an additional fee layer here, and of course that reduces the net return, but actually does it? And the data is very interesting here because actually the opposite is true. So let me explain what you see here. So when you compare the average multiple, so you do an average of the money multiple, one's for single funds and one's for fund of funds. What you will find then is that fund of funds perform at least as good as single funds overall on average, if not even better. And this is, to my point of view, astounding. So I find it very interesting. And you could think about the reason for this. And although it's a bit speculative, but I think a good argument can be made if you decompose private equity investments into different stages as it is seen here. That is the buyout stage, which is a more mature stage of firms versus the early stage of venture capital. And as you can see here, where the difference is largest in venture capital, well, why is that the case? Well, you could imagine, or what we see is that for venture capital, there is a very heterogeneous landscape of individual funds. And Andreas, you showed that. So you have a lot of funds, especially different in terms of capitalization, business focus, also business acumen of the fund managers. And as from the perspective of a fund of fund manager, it is actually crucial to screen a large pipeline of this investment universe and make sure that you only select the creme de la creme, only separate the wheat from the chaff effectively to actually get this, I would call it selection bonus of a fund of fund manager. And you can also argue, okay, why is that so present in venture and not in buyout? Structurally, I would argue that for buyout, which is also more mature, and here already single funds are capitalized up to the billions. Many people know what they're doing, and hence the selection premium you would earn is it's still there, and it compensates roughly the additional fee layer. So it just don't have any on average net effect here, but it's more prominent on the venture side. Now, if you take this private equity stage allocation in terms of average money multiple, you can actually project it on the impact segment or the allocation that you showed in the beginning, and come up with a simulated, so anticipated average money multiple. And again, here you would also end up with a selection bonus of about 0.5x, which is quite significant. So if you put everything together, you've seen that you have fees, but you get something in your fees. It's undisputable that you have a massive reduction in terms of risks, and you still have arguments also in terms of return. So as an investor, if you're facing a new asset class and you want to explore a new asset class, we believe, or our opinion is that a fund of fund investment is the method of choice. So with this, I would hand back.
Perfect. Thanks, Lorenz. So, ladies and gentlemen, if you now agree that the fund of funds approach to impact investing should increase your returns, there's probably only one question left to answer. And this is, what is it that you should look for when selecting the right fund of funds? And I would say there are many aspects that are relevant selection criteria, but in a nutshell, we would argue just look for a safe pair of hands. Look for someone established. Look for someone with a track record of doing things successfully. Look for someone who is able to support you end to end. And look for someone who's aligned to your interests. And if you now ask, well, who could this be? Well, we have someone in mind. Thank you for your attention.
Thank you,
Robert, back to you.
Andre. Thank you, Andreas, Thorsten, and Lorenz. I had a few questions. If you could unshare your screen as we start this conversation. If anyone has a question, just type it in the chat area, and I'll address that as we move forward. And I wanted to ask Andreas, so what is the process for selecting the fund? You have, like you said, you had a universe of 900 funds. So how do you select funds from such a large universe?
Oh, that's a big question. That's what me and my team spend all our time doing, basically. So obviously we would narrow it down, the funnel, by applying criteria such as strategy and track record, size, etc. From these 900. I mean, we have looked at, we do deep dives. We did a deep dive in developed market food and ag tech funds, and we looked at 70 funds. We did the same exercise for early growth funds, Europe, North America, recently, and we looked at 130 funds before making our latest investment. Basically, we look for a lot of things that any private equity investor would look for. But in our case, I think it's very important that we look for, just in terms of the strategy, we look for fast scalability, unit economics that work for customers and companies, and large markets. And this is a bit special. This is the impact angle, I would say, that can be different from others. When it comes to assessing the best team, once you have a strategy that works, you have maybe several funds with a similar strategy, it clearly comes down to teams with top quartile track records and experience in their sector, and best-in-class sustainability and impact processes.
You, Lorenz, I wanted to ask you a question. Having researched a bit about Golding, and so you've launched 60 funds over 20 years and close to 15 billion in assets under management, and no LP has ever lost money, which is quite amazing. Does your analysis mean that there is no fund of funds that can lose money?
No, it doesn't. And actually, if you recall, I was a bit cautious when I told you this is the worst data point, which still has a positive return. This is what, the available statistical data tells you, and it fits to what we from our 60 investments see. If you slice and dice also the available data properly, you will find some data points that are below a multiple of 1, meaning that there are data points that have a multiple of less than 1. So there are examples where you can lose money. But again, in terms of statistics and probability of that to happen, empirics say that it's very unlikely. So I'm cautious, I'm, mathematical background, so I'm talking about probabilities, and I would say not never, but it's very unlikely. That's what research tells you.
Okay. Before I had a couple of other questions. I have a couple of questions from the audience that I want to address. Gonzalo, that I want to know. I guess the strategy is generic to any type of investment fund, not just impact funds. It makes sense in terms of financial performance. Is the impact performance tangibly better or just on par with a single fund approach?
So if I understand the question correctly, the question is do these risk-reward considerations that we saw from Lorenz apply also to the impact world, or does it apply in a different magnitude? The impact space is still quite new, so we don't have this whole study just for impact funds. So what Lorenz showed you was the whole universe globally of private equity funds. I would argue that the case for a fund of funds is even stronger due to the nascent market of funds, that there are many newcomer funds, and that the dispersion of returns will be even higher for these funds. I would also argue that the selection bonus, as Lorenz called it, would be greater, because understanding the different sectors and navigating that is even more of a challenge when it comes to impact investing. So yes, I think it's we expect the impact metrics. Here is the
impact
addition
metrics,
to the question. Thank you, Gonzalo. The impact measures. I see. The impact performance. Okay, here's the thing. Here's how I see it. Great question. Thank you. There are the same reasons for diversification apply to the impact dimension, right? Meaning that if you have a single fund and it's not as good as you hoped it would be, your impact will also not be what you hoped it to be, right? So in order to ensure a high level of impact that doesn't really fluctuate by individual assets, you need a large diversified portfolio, which you get through a fund of funds. The second benefit, so that's kind of the impact risk part. I would also argue that investors oftentimes want to be part of exciting new companies, participate in journeys that have helped us accelerate the transition. And by having a broad global portfolio, you will be part of these kind of companies, because a fund of funds would typically have between 200 and 300 companies in the portfolio, which will mean that you will have access to these individual companies, you will be reporting on it, and also see what the impact of these individual companies is.
Okay.
Maybe to add on that question as well before I come to the new, there's also a different side, because the empirical data basically is only based on capitalization in to some degree, and no ESG metrics or whatever is taken into consideration. Now, if you would take into consideration ESG risk in terms of economical risks or even regulatory risk for institutions, which are likely to be more dominated in the future, I think also this risk return profile would shift further towards impact compliant investments.
Okay. Next question, Remy kind of grabbed onto the question I wanted to answer about a global strategy. How would you make your geographical allocations between North America, Europe, and Asia, but also across countries in these regions?
I would argue that as an investor, another complication is that you also need to find the right balance of target. When it comes to the target funds, how narrow are they set up? So when it comes to, for example, saying we only invest in if a fund is a single country fund, as they call it, this particular target fund invests only in one country, is different to being a pan-European fund. And all of that needs to be weighed together. What's the geographic exposure that you have through a whole fund of funds construct, but also with regard to sector and stages. So there is always a very long, internal debates and analysis when it comes to the portfolio construction, right? So single country funds may be really successful, but maybe they're too narrow. Maybe the market is not big enough there. Maybe there are other issues. Maybe the risk is too high. Maybe there's an FX issue there. So we weigh that in, I would say. So maybe the Nordic region is one region that we would do. We wouldn't just do Denmark, to throw it out there. A pure Danish fund would perhaps be too risky for us. The next thing, though, is what's the benefit of this approach is that if we were to have, say, as a target fund, a fund that's pan-European, the beauty of that is that the funds we select are the experts in the sector. They are so deeply into the technologies, into the markets, into the customer demands of this sector, but they also know which regions, which countries are best for that. So the point of a fund of fund is to have someone assess the managers, assess the strategies, but then also to let the manager of the target fund have some discretion when it comes to choosing between Denmark or Sweden or Germany or UK or France. That's another benefit, I would say, of the fund of funds model.
Okay. Guido wanted to know, could you say something about the liquidity profile of fund of funds versus single funds? Are fund of funds able to distribute earlier due to diversification? Any one of you?
So, Andreas, do you want to take this?
Yeah.
I don't care. Andreas can.
I was thinking how technical. Well, Lorenz, you go for it. I think they listen to you. Trust you the most on this.
To be honest, I'm not the expert in that respect. These are my colleagues, but it is certainly true, and we talked about that we have, of course, diversification of cash flows, meaning that when you have a single fund, maybe it doesn't perform as well, or the exits of the underlying portfolio is, prone to some events. You might, of course, prolong the period, or you might lose anticipated cash flows in a certain period of time. And that is certainly true also for the fund of fund, that diversification also takes place on the level of cash flows, meaning that they're more reliable in terms of what can you plan or what you can anticipate in terms of cash flows. So we have a dedicated team that does exactly that. So they forecast and plan cash flows. And there is also some degree of steering in that, meaning that you could also, so if one fund is, for instance, in trouble, you could compensate that with the distribution of other funds. And that is the present. And we get, also in these times, we get happy messages from our investors that are glad that our investments or the cash flow from our investments is more plannable than for direct investments or single funds.
Right, and if I may add to this, Lorenz, that's perfectly right. We provide a cash flow profile that forecasts the annual cash flows across the term of the fund. We do this biannually. We update this biannually with the actuals and the updated forecasts. And it's certainly right that the cash flow overall for a fund of funds in private equity is probably the same as for a single fund in private equity, but with less volatility of outcomes. That's what Lorenz said, and that's certainly right. So the risk of having maximum delayed distributions out of anything that happened on a single fund is compensated for with the other funds that you have in a fund of funds portfolio. So it's just less volatile.
And also same goes for the drawdowns, right? Not only distributions, meaning that we do financing measures, so to overcome, the risk of missing a capital call, etc.
Right.
That answered your question.
Sorry about that. Why are venture capital focused fund of funds more able to create a return that outweigh the fund of fund fees, or are they?
Well, I tried to address that a bit in what I speculated on the reasons for this selection bonus. And to my opinion, and I think Andreas can add to that, it's because there is a heterogeneous landscape in particular for venture capital funds. So there are many small cap funds which might, have a greater risk of not making up or not returning as much as the larger funds, and you need to make sure to only select those very good funds. And this is more important in the venture stage than in the buyout stage, where mostly all of the funds are very sophisticated.
Yeah, I would just add to that. I think the selection bonus sounds like we do it better. Why is that? I think there is clearly information asymmetry here, whereby someone who is following hundreds of funds on a daily basis is just better informed about what does a good fund look like. And that's one thing. So there's an information advantage, I would argue, for a fund of funds compared to other investors and the overall market. And perhaps it's also about the investment discipline, because in growth stage and in venture capital funds, investors can be very driven by a certain strategy or a team. I think we are very disciplined when it comes to making investments and picking only those funds that we think are the absolute best in each category. So that could also play into why it matters more in venture capital than in buyout.
I had a question about your due diligence process, which some would say are brutal, so others would say are thorough. It's quite tough. I mean, you really get really very deep. And I was curious that one of the funds that you were looking at was a very big fund. It was many, a couple billion. And you were asking them to go through so many hoops, even though they had raised close to the billion. Why, and you're not going to be putting in 100 million in there. So why do they do that? Why? What is the benefit for them of going through such an intensive due diligence process?
Yeah, so I guess we do actually a lot. Yeah, so we negotiate, as I said, LPA side letters. We demand a lot of information. We go see the companies. We go do site visits of existing portfolio companies, for example, and take a lot of time to do this. Obviously, we do it in a very organized way, but we do require a lot of attention. And I think the benefit is that we can do that. We represent a whole host of investors, of LPs. So given that we pool this capital, we have a larger say when it comes to negotiating terms and requesting information. That's one thing. Another thing is that we have been fortunate to be perceived by funds at really being able to add value, in particular when it comes to the way they should improve their impact processes and the management of that. We clearly have spent a lot of time on this, as have they, but we see the whole market. We see what other funds are doing, and we can share this best practice. So as it happens, not only do we do a lot of due diligence, ask a lot of questions, they actually like it, and they invite us to sit on LPACs, on the advisory committees, because we do have such a broad insight into what others are doing and the ability to share best practices. So we actually, despite our questions, are received very positively, surprisingly enough.
I don't think this is Gonzalo because it's a woman's photo here. How will investors be able to track progress on impact achieved across such a diversified portfolio? This is about reporting. Excellent question. Thank you. I see that we have sort of a few minutes left. This is almost a separate webinar. As I mentioned just briefly, one of the value added that we do to investors is that we receive impact data from all our target funds and all the portfolio companies and aggregate this and analyze and monitor it, but also communicate it to our investors in a condensed way. So we have a certain number of impact metrics that we aggregate for the whole fund. This could be CO2 avoided CO2 emissions, or resource efficiency. That we aggregate on a portfolio of a fund-of-fund level. But we also monitor each individual company to make sure that they're on track for their impact targets. So we do that to ensure that they're staying on track. But we also go the extra mile, as I said, to help investors get aggregated fund-of-funds data.
Maybe to add on that, so in terms of what that means, in operations. So in finance, we have a dedicated team, a large team that is dedicated to collect all this data despite having such a diversified portfolio. So that's why we have such a large database. But we also have a dedicated ESG team that does exactly that. So they track exactly what you described, Andreas. They just recently came up with a report where we sum up all these things that you just mentioned. Okay, one final question from Ben Bingham in the US. When you spoke about financing for capital calls, how do you manage the liquidity, cash alternative, risk-free options, ESG stocks, carbon futures, sorry?
Question. Lorenz, or Thorsten, you want to take that?
Yeah, sure. Well, it's not cash alternatives or risk-free options or anything. It's just credit facilities that we use, short-term credit facilities that we use to manage the drawdowns, or let's say capital calls of our fund of funds, to make it more stable over time and a bit more predictable. So because we usually draw down the capital in small amounts of 2 to 3 to 5% of committed capital, but don't want it to come across with every 1% of capital calls. But this whole process is really for a fund of funds pretty much the same as for any single funds in the private equity world. So you commit a certain amount, let's say 10 million, and then we would draw down this committed capital over time in our fund respect, for example, over the course of 5 years, and as the capital is called, it is invested via the primary fund commitments that we did, and the underlying companies that will be bought by the target funds. So there's a capital drawdown pattern over time, and to make it to accommodate your requirements, basically there's a little bit of credit facility in place, but nothing else, nothing exotic.
Maybe to add to that, this is not a credit facility in terms of leverage, but it's only to pre-finance those capital calls. So they're closed within weeks from capital calls.
Correct.
We're coming to the end because I try to keep it to 60 minutes. I want to thank you all very much for joining us. If any of you have any more specific questions regarding the deck or more information about Golding Capital, you can contact either Andreas, Thorsten, or sorry, it's a bit late.
Lorenz.
Lorenz in Osaka, or just contact us. It will connect you with any three of them. So thank you all very, very much. The replay will be available shortly. We will also send a link which will give everyone who registered access to the replay, and we'll send you at Golding a copy. Thank you. This was excellent. You did an excellent job, and thank you for being such an attentive audience. I appreciate it. And I think that Gonzalo Vedera must be cloning himself, because about 6 different ones. I guess it's different people from the team. So thank you all so much for coming. And Andreas.
Thanks for having us.
Thanks.
Thorsten,
Exactly. Thanks for having us. It was a great pleasure. Thanks everybody for joining.
Bye-bye.
Thanks
Thank you.
for
Bye.